Structured notes combine the security of bonds with the growth opportunity of stocks, offering protection, diversification, and growth potential in a single investment. They're designed to balance risk and return. Many notes include some level of principal protection, helping safeguard your original investment while providing exposure to market gains. Issued by banks and tied to an underlying asset, like a stock index, they vary by term length, return formula, and protection features. Common examples include the S&P 500, Canadian banks, or sector-specific baskets like healthcare or insurance. Banks issue these notes regularly, each with slightly different terms and features, so every note is unique in its blend of potential return and protection. In our clients' portfolios, we primarily use three types of structured notes: auto-callable notes, booster notes, and accelerator notes. Each works a bit differently. Let's look at each one in order. Auto-callable notes offer a predetermined rate of return and the possibility of early maturity if certain market conditions are met. At regular checkpoints, often annually, the bank checks if the index is at or above its original level. If it is, the note is automatically called, paying back your principal plus the fixed return. Some auto-callable notes offer full principal protection. Others have barrier protection. A typical example is a negative 30% barrier, meaning if the market does not fall more than 30% from its starting point, your capital is protected. Let's take a look at this example of an auto-callable note linked to the Canadian Diversified Large Cap Index. It has a term of 5 years, a fixed return of 12% per year, and a barrier protection of negative 30%. The note checks the index each year on the observation date. If the index is at or above the starting point, the note is automatically called and pays 12% per year held. Here are the possible outcomes. Year 1, the index is slightly below, so it is not called yet. Year 2, the index is close, but still under, so it continues. Year 3, index is above the starting point, the note is automatically called, you get 12% times 3 years equals 36% total plus your principal. If the note runs to the end and the index is below its starting point, the negative 30% barrier provides protection. If the index is down less than 30%, you get your principal back. If it's down more than 30%, your capital loss matches the index. Booster notes are designed for investors who expect modest or flat growth, but want an enhanced return if the market is even slightly positive. These notes deliver a strong, preset return if the index ends at or above its starting point, regardless of how small the gain is. If the market falls, a protection barrier helps reduce your downside risk. For example, let's take a look at this booster note, linked to the Canadian Diversified Large Cap Index, this time with a 7-year term. The booster return is 125%, which is approximately 12.27% per year, with a protection barrier of negative 20%. At maturity, if the index finishes flat or positive, you receive the full boosted return. For example, the market rises slightly, you get 125% total return. If the index soars beyond 125%, you earn the actual higher market return instead. If the index is down less than 20%, your principal is protected. If it's down more than 20%, your investment takes the same loss as the index. Accelerator notes offer a return that multiplies market gains, ideal for investors who believe in moderate to strong growth. Unlike auto-callable notes, these don't mature early. You hold them to the end of the term. Let's take a look at this example of an accelerator note linked to the Canadian Diversified Large Cap Index, with a term of 5.5 years, a return multiplier of 650%, and a 0% protection barrier. At maturity, your return equals 6.5 times the index return. For example, the market goes up 10%, you will earn 65%. If the market goes up 20%, you will earn 130%. Accelerator notes can have protection barriers, but unlike the other notes we have discussed, this one does not, meaning you would take the same loss as the index if the value was less than the starting amount at the end of the term. It's important to remember structured notes can help balance risk and return in a portfolio. They offer various protection levels and return profiles, and choosing the right note depends on your market outlook and risk tolerance. Be sure to always review the specific terms and features of any structured notes before investing. Thanks so much for watching. If you'd like to stay connected, check out the links in the description to follow us on Facebook and Instagram. If you have any questions or need help with your financial planning, feel free to give us a call. We're Brant Financial Group with Asante Capital Management Limited, and we're here to help you plan with confidence.